China's economy was supposed to drive a third of global economic growth this year, but its dramatic slowdown in recent months is ringing alarm bells around the world. The question on everyone's mind is whether China could spark a global economic collapse. What could trigger such a scenario, and how would it all play out? Let's dig in and unpack the potential fallout. Okay, so we all know that China is the second largest economy in the world, or the largest, depending on how you look at it. It's often called the factory of the world because so many products and parts that go into those products are made there. This makes it clear that, under the right conditions, China could trigger a global financial crisis. While something as extreme as war would be drastic, a major slowdown or recession in China could definitely pull the rest of the world down with it. In fact, this very scenario has been a significant concern for policymakers and analysts for years. To clarify, China is already experiencing a slowdown, but the overall impact is unclear because every country is facing a slowdown due to COVID-19. By April 2020, China's economy had shrunk by 6.8% in the first 3 months compared to the previous year, marking its first reported reduction since 1976, right as the Cultural Revolution was winding down. Although it bounced back in 2021, there are worries that several headwinds could contribute to another significant slowdown. These include the ongoing US-China trade war, high levels of Chinese debt, a property market crash triggered by Evergrande, and energy shortages on top of COVID-19. The big question is, how much would a recession in China affect other countries? Would it be as bad as or worse than the global financial crisis, GFC? Interestingly, a similar scenario nearly played out just a few years ago. During the tumultuous period between 2015 and 2016, China's stock markets experienced a significant downturn. In June 2015, the Shanghai Composite Index dropped about 30% in just 3 weeks, dragging global markets down with it. It was an exciting time for market reporting, with clear signs that China's economy was slowing. In response, China's central bank decided to devalue the yuan against the US dollar. While this made Chinese exports cheaper and more appealing, the move shocked global markets and caused billions of dollars to leave the country. After all, no one wants their money tied to an unstable situation. This outflow of cash left banks at risk of running low on capital, which was reminiscent of what happened during the global financial crisis. When banks have less money to lend, the economy can come to a standstill. A lack of cash or liquidity in the markets is a key trigger for major financial crises. Another major trigger is a high level of bad debt, and many argue that China already meets that criterion, which will be explored in the later part of the video. By October, the IMF was holding urgent meetings to discuss whether the situation in China might lead to another global financial crisis. Fortunately, swift policy actions helped stop funds from leaving the country, allowing China to weather the storm, and soon the world forgot it had ever happened. However, the question remains, could it happen again? In an interview last year, Tom Orlick, Bloomberg's chief economist and author of China, The Bubble That Never Pops, shared his perspective on how such a crisis could unfold. He explained that it would begin with a single borrower defaulting on a loan. As banks reassess the risks of lending to smaller borrowers, they would start to cut back on lending and refuse to roll over loans. This would cause defaults to spread, transforming an initial problem into a systemic crisis, creating a self-reinforcing shock similar to what the US experienced after the Lehman Brothers collapse in 2008. In this scenario, China's growth, which might return to 4 to 5% per year after the COVID shock, would plummet, leading to a period of economic contraction. For those keeping up with the news, This situation might sound familiar, as it reflects what happened with the Chinese property giant Evergrande. Currently, Evergrande stands as the world's most indebted real estate firm, with debts nearing $300 billion, and on the brink of collapse unless the Chinese government steps in to bail it out. The crisis is already showing warning signs. Just weeks after Evergrande defaulted, another property giant, Fantasia, missed a debt payment of over $200 million. Concerns that this could lead to a repeat of the Lehman Brothers crisis prompted U.S. Secretary of State Anthony Blinken to warn that Evergrande's failure could affect the entire world. The reason for this concern is that China's growth story heavily relies on the property sector. As of 2016, real estate and construction accounted for 30% of the country's GDP, up from just 10% in 2000. Today, China's property market is valued at around $60 trillion. While a property collapse in China would be serious, many analysts believe that Evergrande's downfall is a different situation from what happened with Lehman Brothers. IG market analyst Kyle Rodda argues that even if Evergrande collapses, it's unlikely to trigger a crisis like the global financial crisis. This is mainly because Evergrande isn't as linked to global financial markets as Lehman Brothers was. In fact, out of the $300 billion owed, only $20 billion is owed to foreign lenders. While this is still a significant amount, it's unlikely to cause the same level of damage seen during the GFC. Therefore, an Evergrande collapse wouldn't necessarily lead to an immediate global crisis. A chain reaction of companies going bankrupt worldwide isn't likely to happen, but if the situation isn't managed carefully, it could lead to a significant slowdown and even a deep recession in China. Tom Orlick argues that if China's financial system collapses, the immediate effects might not ripple through the global economy right away. Instead, there could be a sharp decline in global stock markets as investors pull their money from riskier assets. The more significant impact would be an economic trickle-down effect, particularly affecting countries that export goods to China, especially commodities. Australia serves as a prime example, exporting 70% of its iron ore to China, which is its largest export revenue source, worth around $117 billion. Iron ore is essential for steel production, which primarily supports Chinese construction. Orlick believes that if China experiences a financial wobble and economic slowdown, Australia's economy and stock markets would likely suffer the most, which is concerning news for Australians. Additionally, a slowdown in China would reduce consumer demand, impacting countries like Thailand. If China's manufacturing slows down, many Asian countries linked to the electronics supply chain could feel the effects. A drop in electronics production would negatively impact Japan, South Korea, and the Philippines. Furthermore, demand for other commodities, such as oil, would likely decrease, causing significant slowdowns for smaller oil-exporting nations like Venezuela. However, Orlick notes that not all countries would be severely affected. For instance, the US and Europe might see less impact. The Evergrande crisis is indeed a situation to watch closely, especially since it coincides with other factors currently affecting China's economy. China is facing widespread power shortages, leading many provinces to implement electricity rationing. This issue arises from various factors, such as restrictions on coal usage to meet carbon emission goals and government price limits on electricity. The result has been disrupted supply chains worldwide, raising concerns that prices for everyday items could skyrocket, creating inflation without wage increases. Major technology and electronics companies, including Apple, rely on China for parts, and prolonged supply chain slowdowns could lead to some electronic companies struggling to survive. While the outlook appears grim, there are some reasons to remain hopeful about avoiding a catastrophic global collapse due to China. One major concern about China is its high debt levels, but most of this debt is government-owned and linked to local businesses. The country is known for its high savings rates, with many citizens choosing to save rather than spend. After the global financial crisis, China introduced various policies that effectively boosted its economy, allowing it to grow rapidly over the past decade. However, the country is now reaching a point of huge debt levels. Most of China's debt is state-owned and often lent to government-owned companies, making it more manageable within China's socialist context. Economist Anatoly Koletsky argues that the numbers often cited about China's debt can be exaggerated to paint a dire picture of an impending crisis. He believes the media tends to blur the lines between a growth slowdown and an actual economic collapse, particularly following the government's response to the 2015 crisis, which included injecting $200 billion into the stock market and devaluing the currency. China has successfully navigated potential crises in the past, largely due to government control over key industries, which provides flexibility in addressing issues. State-owned enterprises account for about 50% of China's output, meaning a significant portion of the economy is effectively managed by the government. While markets are influenced by government agendas, which can lead to biases in lending and resource allocation, this control also allows for more flexible lawmaking, stimulus measures, and crisis management. In conclusion, could a collapse in China trigger a global economic crisis? Yes. As the world's second-largest economy, it could have serious repercussions. However, it's unlikely that the Chinese government would allow such a situation to unfold, as it would ultimately harm China itself. The Chinese Communist Party is committed to maintaining long-term growth, and so far, it has demonstrated the ability to execute its plans effectively. What are your thoughts? Do you believe China is heading for a recession or slowdown that could affect the rest of the world? What do you think that might look like?